Chapter 2 illustrates basic accounting procedures by analyzing the business transactions of a sole proprietorship in a service business. The first objective of the chapter is to record in equation form the financial effects of a business transaction. The accounting process starts with the analysis of business transactions. The accountant analyzes each business transaction to decide what information to record and where to record it. For example, purchases, sales, payments, and receipts of cash are all business transactions. Let's analyze some of the transactions of Wells Consulting Services. This is a brand new business. Let's start from the beginning. Carolyn Wells obtained the funds to start the business by withdrawing $100,000 from her personal savings account. The separate bank account helps Wells keep financial interest in the business separate from her personal funds. When a business transaction occurs, it is analyzed to identify how it affects the equation property equals financial interest. This equation reflects the fact that in a free enterprise system, all property is owned by someone. The basic equation is property, assets, equals financial interest, creditors and owners. Property is anything of value the business owns, its assets, and financial interest represents what the business owes to its creditors or its owner. Objective 1 is to record in equation form the financial effects of a business transaction. An owner's financial interest in the business is called equity or capital. Carolyn Wells has $100,000 equity in Wells Consulting Services after this investment of $100,000 of her own money. To record this transaction, we increase cash by $100,000. Cash is considered property in the business. To keep the equation in balance, we have to increase the right side of the equation by the same amount. Since the $100,000 came from the owner's personal account, we increase the Carolyn Wells capital account to show an increase in the amount the business owes the owner. After recording this transaction, the equation is still in balance. What is equity? Equity, or capital, is the owner's financial interest in a business. As the owner invests more of his/her personal funds into the business, his/her financial interest in the business increases. Equity is the amount that the business owes the owner. In order to do business, the company needs to use some of the cash to purchase equipment. Wells Consulting Services issued a $5,000 check to purchase a computer and other equipment. In this transaction, cash was exchanged for equipment. Both cash and equipment are considered property, so only the left side of the equation is affected. To record the transaction, cash decreases by $5,000. Equipment increases by $5,000. The left side of the equation totals $100,000 and the right side equals $100,000. After recording the purchase of the equipment in the equation, it shows that the total value of the property remains the same. Carolyn Wells' financial interest or equity is also unchanged. Now let's see what happens when Wells Consulting purchases some additional equipment, this time on account or on credit. When a business is allowed to charge for a purchase and then pay for it at a later date, this is called buying on account. The business that is allowing you to purchase items on account is referred to as a creditor. A business needs to keep track of how much it owes to creditors. An account called accounts payable is used to accumulate the amount a business owes to creditors. In this account, the company purchases $6,000 of equipment on account. Take a look at the equation and how it changed. After recording this transaction, the accounting equation remains in balance. The left side, total property, increases to $106,000, and the right side has also increased to $106,000. In this transaction, the business purchased $1,500 of supplies so that it could start operations. Again, we analyze the transaction to determine how to enter or record it into the equation. An analysis of this transaction is as follows. D. The firm purchased office supplies that cost $1,500. D. The firm paid $1,500 in cash. To record the transaction, we subtract $1,500 from cash. Supplies are a form of property now owned by the business, so we increase it by $1,500. Since the transaction both increased and decreased only the left side of the equation for the same amount, the equation continues to equal $106,000, and it remains in balance. In this next transaction, the business is going to pay off part of its debt for the office equipment purchased earlier. In order to reduce its debt, Wells Consulting Services issued a check for $2,500 to an office supply store. To record the transaction in the equation, cash decreased by $2,500 and accounts payable decreased by $2,500. Now, Wells Consulting only owes $3,500 on the equipment purchase. After recording the transaction, the equation remains in balance. The left side, property, equals $103,500, and the right side, financial interest, also equals $103,500. The business's landlord requires the first 2 months of rent to be paid in advance. As a result, the firm obtained the right to occupy facilities for a 2-month period. In accounting, this right is considered a form of property. To record the transaction, we reduce cash by $8,000. We also need to add a new account, prepaid rent, to the left side of the equation. We increase this account by $8,000. After recording the transaction, the accounting equation remains in balance, $103,500 on the left and $103,500 on the right. The second objective of Chapter 2 is to define, identify, and understand the relationship between asset, liability, and owner's equity accounts. Accountants use special accounting terms when they refer to property and financial interests. For example, they refer to the property that a business owns as assets. The value of an asset is tied to its revenue-generating capacity. Accountants refer to the debts or obligations of the business as liabilities. A good example of a liability is the accounts payable or debt the business incurred when it purchased equipment on account. Owner's equity is the term used by accountants to keep track of the owner's financial interest in the business. At regular intervals, Carolyn reviews the status of the firm's assets, liabilities, and owner's equity in a financial statement called a balance sheet. The balance sheet shows the firm's financial position on a given date. It reports the assets, liabilities, and owner's equity of the business. If we look at Wells Consulting Services' balance sheet, which was prepared on November 30 after its first month of operations, we can see that the business has total assets of $103,500 and owes $3,500 to creditors. The owner's financial interest in the business, Carolyn Wells Capital, is $100,000. The balance sheet also shows the equality of the equation. Total assets of $103,500 equals total liabilities and owner's equity of $103,500. Remember the financial equation we learned earlier. Property equals financial interest. The third objective of Chapter 2 is to analyze the effects of business transactions on a firm's assets, liabilities, and owner's equity, and record these effects in accounting equation form. In this section, we will also learn how to prepare financial statements. In accounting terms, the firm's assets must equal the total of its liabilities and owner's equity. We use the fundamental accounting equation to ensure that this relationship is in place. This equality can be expressed in equation form. The relationship between assets and liabilities plus owner's equity is called the fundamental accounting equation. All business transactions are recorded with this accounting equation in mind. It must always remain in balance. We will continue to record transactions for Wells Consulting Services using this fundamental accounting equation. When a business performs a service or sells a product, it generates revenue. Wells Consulting Services earns revenue by performing accounting and bookkeeping services for its clients. Expenses, on the other hand, involve the outflow of money, the use of other assets, or the incurring of a liability. Expenses include the costs of any materials, labor, supplies, and services used to produce revenue. Consider this transaction. During the month of December, Wells Consulting Services earned a total of $36,000 in revenue in cash from clients. An increase in revenue is an increase in owner's equity. When the business earns revenue, it is really the owner who benefits. Here is an analysis of the transaction. G. The firm received $36,000 in cash for services provided to clients. Increase cash to show that our bank account increased with the influx of the cash received. G. Revenues increased by $36,000, which results in a $36,000 increase in owner's equity. Notice that revenue amounts are recorded in a separate column under owner's equity. Keeping revenue separate from the owner's equity will help the firm compute total revenue more easily when the financial statements are prepared. Let's take a look at how a transaction for services provided on account would be recorded next. Here we see accounts receivable, an asset, has been added to the accounting equation. We use accounts receivable when someone owes us money for something. To record the earning of the $11,000 of revenue on account, we increase accounts receivable by $11,000 and increase the revenue account by the same amount. The accounting equation remains in balance. Previously, the business recorded some revenue earned from providing customers with services on credit. Now, some of those customers are paying the amount they owe. During December, Wells Consulting Services received $6,000 on account from clients who owed money for services previously billed. The effect of these transactions is analyzed below. I. The firm received $6,000 in cash, and accounts receivable went down by $6,000. Notice that cash is going up and accounts receivable is going down. This is called a shift in assets, because we are replacing one asset for a different asset. The amount still owed by charge clients after the collection is $5,000. After recording the transaction, the accounting equation remains in balance. $150,500 equals $150,500. Notice that when we collect from a client on account, we do not increase the revenue account again for this transaction. This would duplicate the revenue for the same work. So far, the business has been doing well, but running a business costs money, and these expenses reduce owner's equity. During the first month of operation, Wells Consulting Services hired an accounting clerk, and now it is time to pay her for her work. Her salary is considered an expense to the firm. In December, Wells Consulting Services paid $8,000 in salaries for the accounting clerk and the office manager. The effect of this transaction is analyzed below. J. The firm decreased its cash balance by $8,000. J. The firm paid salaries expense in the amount of $8,000, which decreased owner's equity. To record this payment of the accountant's salary, the cash account is reduced by $8,000 and the owner's equity is also reduced by $8,000. We are going to keep track of expenses in a separate column under owner's equity heading called Expenses. Notice that total assets and total liabilities plus owner's equity both equal $142,500. Notice too that while expenses are added to that column, plus, the total of expenses is always subtracted, since expenses decrease owner's equity. Heat, light, telephone, and water are all utility expenses, which the firm incurs in doing business. As these bills come in, the business must record the expenses. Wells Consulting Services issued a check for $650 to pay the utilities bill. The effect of this transaction is analyzed below. K. The firm decreased its cash balance by $650. K. The firm paid utilities expense of $650, which decreased owner's equity. In the accounting equation, cash is reduced by the $650 check payment, and owner's equity is also decreased by the same amount. Notice that as total expenses go up, it causes the total owner's equity to go down. The accounting equation remains in balance. At the end of December, Carolyn Wells withdrew $5,000 in cash for personal use. The effect of this transaction is analyzed below. Withdrawals are not considered a business expense, but a decrease in the owner's equity. Cash is going down by the $5,000 withdrawal of cash, and the total owner's equity is going down by the same amount. Remember that when we recorded the investment in the business, we recorded an increase in C. Wells' capital account. Now, when the owner withdraws funds for personal use, we decrease the C. Wells capital account for the withdrawal. After recording the withdrawal, the owner's capital account has a balance of $95,000. The accounting equation still remains in balance. Notice that while amounts taken out of the business by the owner decrease owner's capital, in practice, we use a separate account called drawing, which acts like an expense account. It is increased every time there is a withdrawal of assets by the owner for personal use. But like expenses, the drawing account decreases owner's equity. Earlier in the chapter, we looked at one financial statement called the balance sheet, which showed total assets, total liabilities or debts, and total owner's equity. In Objective 4 of the chapter, we are going to look at another financial statement of the business, which is called the income statement. Unlike the balance sheet, which is dated on a specific date, the income statement is for a period of time, such as a month, a quarter, or a year, and it is the first financial statement prepared for an accounting period. The income statement shows the revenue earned and the expenses incurred for that specified period of time. You may hear it referred to as a profit and loss statement or a statement of income and expenses. If total revenue is greater than total expenses, then the difference is called net income. However, if during the period expenses are greater than total revenue, then the difference is a net loss. In the rare case when revenue and expenses are equal, the firm is said to break even. In preparing a formal income statement for a business, the heading contains 3 lines: who, what, when. The top line contains the name of the business, the second line shows the name of the financial statement, and the third line, called the date line, describes the period of time for which the financial statement covers. This financial statement is only for 1 month's worth of revenues and expenses. Under the heading of revenues, there is only one listed revenue account, fees income. For the month of December, total fees income was $47,000. Below the revenue section is the expenses section. All expenses are listed individually and then totaled. For the month of December, total expenses are $8,650. For the month of December, Wells Consulting Services earned $47,000 of revenues and had total expenses of $8,650. The difference of $38,350 is the net income for the month. If the expenses would have been more than the revenues, the bottom line of the income statement would have been a net loss. Note that the statement of owner's equity has a 3-line heading: who, what, and when. Let's take a look at this statement on a line item by line item basis. The first line is the amount of the owner's capital at the start of the period. The next line is the net income, which caused owner's equity to go up. If there had been a net loss reported on the income statement, then the net loss would have caused a decrease in owner's equity. Withdrawals by the owner are a decrease to owner's equity. The total of changes in equity is reported on the line increase in capital or decrease in capital. This is the difference between the net income and the withdrawals. The last line of the statement of owner's equity is the capital balance at the end of the period. In preparing a balance sheet, remember the 3-line heading, who, what, and when. The when, date line on the balance sheet is only good for 1 day, but the other 2 financial statement date lines show a period of time. Put another way, the income statement and the statement of owner's equity are like a movie covering a period of time, but the balance sheet is only a snapshot of 1 day. Note that the ending capital balance from the statement of owner's equity is also used to prepare the balance sheet. Dollar signs are omitted when financial statements are prepared on paper with ruled columns. Preparing financial statements is one of the accountant's most important jobs. Each day, millions of business decisions are made based on information in financial statements. Financial statements are always prepared in a certain order. Spend a few more minutes reviewing the flow of the data from one financial statement to another. Notice that net income, or loss, is transferred to the statement of owner's equity. The ending capital balance is then transferred to the balance sheet. These financial statements will be used throughout the term. They are very important. Make sure you are familiar with them and can prepare them before moving on to the next chapter.